Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased and privileged to have Dr. Robert McHugh with us today. He's in, normally we would have Michael Oliver. Michael is traveling, but Dr. McHugh is one of two technical analysts that I pay so much attention to. He is the author of The Coming Economic Ice Age, and I would really strongly suggest that folks go out there and purchase this book. It is out there now for a couple of years, but it really, I think, is prophesying what is happening, and I think what we're seeing unfolding right today and over the last couple of weeks is definitely in line with what Dr. McHugh has been forecasting. Thank you so much for joining me again, Robert.
My pleasure, Jay.
Really good to have you with me, and I guess we want to tell people to go to Technical Indicator. Help me out with your website now. I'm sorry, I didn't have that in front of me.
No problem. TechnicalIndicatorindex.com.
TechnicalIndicatorindex.com. I get emails, and I go there every day, and I don't pay attention to what the website address is, but I want to thank you again for being with us. You know, I was listening this morning, Louise Yamada, who I'm sure is a name that's familiar to you. She was on Tom Keene this morning on Bloomberg, and Tom Keene says, "You mean to tell me that the bull market is over?" And she said, "I mean to tell you that the top is in." That the bear market of the last 7 years is over. The bull market of the last 7 years is over, and of course that wasn't something that Tom Keene really wanted to hear. But again, you know, this morning as I look at your work, you're talking about the top is in not only for this bull market that Louise Yamada is referring to, but a longer one, the 1987 one, and then you go back to the 1700s, which is, you know, it just is something that's unfathomable for most people. Can you explain? I'm assuming then, of course, that you agree with Ms. Yamada that the bull market is over, and that we're heading into a bear market. But can you sort of explain to people why you think this is a bigger deal than what Louise Yamada implied in her remarks to Tom Keene this morning?
Sure, Jay. There's two technical sciences I've used to come to that determination. One would be the Elliott wave analysis, and if you look at the wave counts, the wave mapping from going back to the beginning of 1900s, the Great Depression that happened in the 30s was a bear market of supercycle degree. It was huge. But then the wave count from that point to the present has a completed 5-wave rise, which finishes off cycles, and that completed right this year in the spring, and that is 1 degree higher than what the Great Depression of the 30s was. That has to be a supercycle degree, which goes all the way back to the 1700s, where they tracked market success and failures from England, and also going back to the tulips, Holland tulips, and that kind of thing.
Tulip mania.
So. So we can be sure of that from that perspective. And then the other technical analysis science that tells me the same thing is this jaws of death pattern. It's a pattern. Patterns show up in stock prices that give us pictures, and these pictures have meaning. They're communicating to us. And we have one of the largest broadening tops, what I call megaphone top or jaws of death tops, that I've ever seen that may have ever existed in modern times. Certainly, it's huge, and it goes from 1987 is when it started all the way up to now, and it's finished. It finished also in the spring. And declines off of these patterns are dramatic and extensive. And this pattern is calling for a downside target eventually of below 1,000 in the Dow Industrials. Yeah. So we have two different sciences telling us the same thing. Something very, very serious is coming, starting right now, and will lead to major political changes. I think it'll lead to some wars and a change in the entire economic system that we're familiar with.
Well, that is, of course, something that you and I have talked about over the years, and it's something that some of my listeners here are very familiar with. But I dare say that to most people, that is just so far out of the question that most people aren't going to even consider it. But I think you've clearly done your work, your homework, and you have, in good conscience, have been telling your subscribers this for a number of years. for reasons that I think are very well documented. And again, the coming economic ice age, if folks are really interested in understanding this stuff, what is going on and what Robert believes is going on, I think you'd do well to pick up a copy of this wonderful book, The Coming Economic Ice Age, Dr. Robert McHugh. As we look at the markets now, I see we're down 441 points, 443 points as we're talking here now. Last night, this morning, you frequently put out almost every day you put something out. And a lot of times I see it comes into my inbox at around 12:30, 1 o'clock in Eastern time here, regarding the bull market that is, the bear market, I should say, that it's obviously just beginning. You said there continues to be two legitimate wave mapping scenarios for stocks right now. One is the first wave count. You talk about stocks starting down as of yesterday, and I guess a very serious decline that might be underway today. It's seemingly with this 400-point down day. But then you say there's a second wave mapping that gives a bit more upside, and I guess you see that stocks, possibly the S&P, rising up to 2050-ish, somewhere in that range, and the Dow up to 17,250. So as I look at the Dow now, we're at 16,098. The S&P's at 1919. Talk to us a little bit. Given the fact that we're seeing today's activities, today's market weakness, which is just almost extreme with 430 points down now, does this movement today change your thinking in any way? Do you think one of the two mappings are more likely, or do you still see it as a toss-up?
It's still a toss-up. We just had a over 2,000-point decline in the industrials over the last several months, and most of it happened in the last month. And so markets correct. They go down in stair-step fashion, down, up, but the size of the corrections and the size of the moves is relative to the initial major move. So corrections, which I call rallies in a down market, are going to be large. And then corrections are usually form an A up, B down, C up path. We hit a bottom in August 24th, and since then that rally that was record-breaking for 2 or 3 days was just either all of a subwave correction or part of a subwave correction that goes to those higher levels you mentioned. And what we're seeing today is either the middle wave of that correction, where it'll go higher over the next few days, next week or so, and then I think there'll be an enormous plunge starting in the middle of September, or it could be that the initial decline over the last month is not finished. The rally last few days was just a small correction, believe it or not, and we are now starting the fifth and final wave of that first enormous decline, first wave down, which could go, in that case, to new lows below the August 24th lows over the next couple days. Either way, there's going to be a massive decline, I think, starting in the middle of September, which would be a wave 3 down. Wave 3s are generally your most dramatic. And this thing is just getting started. This is going to be a series of downs and ups and downs and ups with lower highs each time and lower lows, and lots of crashes, and I think that regardless of which small short-term path the moves take over the next week, I think that both, either case, the correction will be complete no later than a week or so from now, and then it goes down very hard, very, very hard.
Well, it's in any event, I should mention to our listeners that you also provide a premium service for serious traders, and it's more costly, of course, but you do provide some trading advice for people as well. And I'm just thinking here in terms of how do you play this thing. I can tell you that I personally can't handle the leveraged shorts or the leveraged ETFs, for example. So I use some single shorts like SH, which is just a 1-to-1, or PSQ on the NASDAQ. But there's really, unless you're really watching the market almost moment by moment, some of those leveraged shorts can be very dangerous, right?
Oh, yeah. I have a conservative portfolio model, and, 80% of it is cash. In times like this,
okay.
Cash is a good place to be. And I may play with, in the a speculative portion of my total portfolio, maybe 10%, where we'll take a shot at some put options or some leveraged ETFs that are short, that are inverse to market, and fool around a little bit with that. And even that's very complicated, and we share what we do at our website, and it's up to individuals to consult with their financial advisor whether they want to get into that game or whether they just want to stay with cash and wait to storm out until the next bounce arrives. But like I said, I don't think that's going to be something that's going to be, there's not going to be a lot of great bounces that'll last very long. You will get bounces, but they won't last a long time.
Well, in fact, you're looking at something, if I'm reading you correctly, something that might last 5 to 7 years here. But you would have some pretty good bounces, I would imagine, some at least, that might get people to think that, oh, maybe it's time to get back in. We've seen the lows now. Yeah. So it could trick people back in, I suppose, right?
Yeah, they're traps. In a bear markets are not, the problem with a bear is he's not out there to help people who are pessimistic about the market who want to make money on the downside. Bear market wants to kill everybody. He wants everybody flushed out of the market, and those spike rallies that you just talked about will kill the shorts. It'll people that are the ones playing the downside will get murdered when those bounces come, and they come oftentimes out of the blue. We're very careful in our analysis to try to identify when they're likely to come. But the problem with bear markets is, it's a wealth preservation scenario. I mean, yes, some top traders can get some wealth out of trading it, but it's a hunker down scenario.
Yeah, well, the hunker down with 80% cash, I can understand then why you might take 20% and some higher risk, higher return shots. But in any event, we just have a couple of minutes left here, Robert. Just gold. You have been talking about gold as bullish as anybody I've seen. This year, at this point in time, talking about 1425-ish, I think, as a possibility yet over the next 4 months. Are you still holding fast to that prediction?
I think so, yeah. I mean, the charts allow for it, and fundamentally what could happen. I think gold is a premium safe haven. I think we're about to see a lot of danger in the political arena, the geopolitical environment. A lot of uncertainty, and at some point, gold's going to become a safe haven. Wars could break out. Tensions. I mean, international tensions are going to be through the roof. China's falling apart, and they were one of the largest economies in the world, and it's going to have an impact on all our international large corporations housed in the United States. I mean, this thing's falling apart. This world economy is unraveling fast.
Yes,
and that creates political issues, possibilities of war. And gold is going to be sought out at some point here. I mean, if I'm wrong, it's not in the next 4 months. It'll be in the next year, as the geopolitical fallout of these prices, this decline, this economic decline becomes evident.
You know, Robert, as I think about it, we're looking at gold in terms of the Dow, gold in terms of copper and energy and so forth, and it has really been rising very dramatically against the equity market over the last few weeks or so. So in real terms, I like to look at gold. What is the real, because it's hard to measure gold. How do you measure gold against a currency that has no basis of merit or foundation? And what is a dollar? As Ian McHugh-Buy liked to say, a barrel of oil is a barrel of oil, an ounce of gold is an ounce of gold. What is a dollar? And so if the dollar and if the global economy is going to tank and implode, unfortunately, I believe it is, and you share those views, well then, who's to say what the price of gold may be in terms of a dollar? Because what is a dollar?
Yeah, I mean, the dollar is very difficult to identify its value. I mean, the Fed just threw $5 trillion in QE programs of printed dollars. They saturated the economy with liquidity, and then we've just wiped out over a third of that QE program in thin air from the stock market crash. So I don't know. They just keep printing and then devaluing and raising the cost of living on us, and at the end of the day, where are we? Worse off, for sure.
Yeah, we're worse off. A very tiny minority of 1/10 of 1% or 1/100th of 1% that are getting rich is imaginable, but the masses, of course, are are not doing well at all, to say the least. Well, we do have to go now. I see our time is up. I want to thank you very much. You know, you were very brave in taking time away from the markets today. We're down 460 points right now, Robert. To have you break away from your computers today, thank you very much for doing that. I look forward to talking to you again sometime in the near future. Thank you so much for being with us.
Thanks, Jay. My pleasure.